For this week 4 in this concept video series, I'm going to put it all together for you with one comprehensive review problem. And the problem is going to be Lopez Delivery Service Company. And they have the following chart of accounts. Remember we talked about a chart of accounts. Cash, account number 100. Accounts receivable, account number 103. Supplies on hand, account 107. So you see the assets are 100s. Now the liabilities, 200s. The equity, 300s. Dividend. Revenue, 400. Account numbers 500 are reserved for expenses. And 600 we set up for income summary. So that's how a business puts together its chart of accounts. Now, I have already set up the ledger with those account titles and account numbers. Next, we look at the post-closing trial balance as of May 31st. That's the close of business, May 31st. This is post-closing. So they've closed out the revenue accounts and the expense accounts are all zero. That's why they're not listed here, because they have no balances. What is listed here are the asset accounts, down to here, the liability accounts, and the equity accounts. Now they're listed, doesn't matter in what order, but they're usually listed in the order of the numbers in the account. Cash has a debit balance of $80,000. Accounts receivable $30,000. Supplies, so on. Buildings $320,000 less accumulated depreciation. Trucks $80,000 less accumulated depreciation. Accounts payable, credit balance, capital stock credit, retained earnings credit. Total debits equal to total credits. So now we can start June 1st. These are the only accounts in our record, in our ledger, that have any balances. As we go through June, any transactions where I earn revenue, I will open a revenue account. And with transactions that incur expenses, I will open then an expense account. To begin with, the first transaction, June 1st, perform delivery services for customers on account, $60,000. June 1st, debit, accounts receivable, $60,000, and credit, service revenue. June 3rd, paid dividends, $10,000. That would be with cash. Debit dividends, $10,000. Credit, cash. June 4th, I purchased a truck, $20,000 on account. I didn't pay for it. I will pay for it later. The debit then is to truck and the credit to accounts payable. June 7th, I collected $22,000 of the accounts receivable that was owing to me. I received cash, so cash increases, so debit cash, $22,000. What is owing to me in accounts receivable has now been decreased by $22,000. On June 8th, I pay $16,000 of what I owe on accounts payable. Therefore, debit accounts payable, $16,000, and credit cash, $16,000. Now, on the 11th, I purchased $4,000 of supplies on account. June 11th, debit supplies on hand, $4,000. My supplies account has increased by $4,000, and my liabilities have increased by $4,000. June 17th, performed delivery services for cash, $32,000. So that would be debit cash, $32,000, credit service revenue. On the 20th, I paid the utility bill for $1,200. Debit utilities expense, expenses are always debited, $1,200, and credit cash, $1,200. On June 23rd, I paid miscellaneous expenses for $600. Again, debit the expense, miscellaneous expense, $600, and credit cash. Now, on the 28th, I paid salaries for June, $28,000. Debit salaries expense, $28,000, and of course cash. The employees wouldn't be happy unless I paid them with anything other than cash. So cash goes down, $28,000. And that completes the business transactions for the month of June. These transactions all had a source document that gave me the amount of the transaction, the timing of the transaction, and the reason for the transaction. And I journalized them in my general journal as we demonstrated. Always debit first and close to the line, and then indent and credit. Now that completes step 1. Step 2 now is that we take each one of these journal entries and post them to the general ledger.